Boom! What is up, Waves Capital? It's Royce Jacob. Welcome back to the channel. In this video, I want to talk to you about why I do not think that the upside we've experienced in the markets over the past month or two is just another bear market rally. Okay? So, based upon the fact that there's so many headlines out there like the one in front of us, I'm sure you're aware that there are plenty of analysts and plenty of investors out there who believe that this is the case. And there are definitely many arguments, which we've covered here on the channel in the past, that do contribute to a bearish argument. We will be touching on some of those today because, of course, a good debate is not a good debate if you're not touching and arguing for both sides of said debate. So we will be touching briefly on the bear arguments, but focusing on the bull case because personally, I lean bullish. Okay, so I will do my best to explain why that is from a fundamental perspective. Right off the bat, want to let you guys know no charts today, but that's because the macro environment is so important right now. And of course, even if you're a trader, even if you trade small caps and growth stocks like I do, and I know many of us do, it's so important to focus on the macro and understand what's going on in the macro, because when you have a sound understanding of what's going on in the macro, in the big picture, it allows you to be that much more refined and that much more competent in the smaller scale. Okay? So, to kick off the video, we will be reading through this CNBC Pro article titled Berenstain Bears says summer rally was just a bear market bounce and to expect more pain ahead. So we will be kicking it off once again with the bearish side of the debate so we can go on to counter that. We'll read a few points here and then move in to a few statements from Mr. Mad Money himself, Jim Cramer. Okay? The reason for that being it just worked perfectly. This touches on how there are many people out there, this analyst specifically, who believe that there are a lot of parallels between 2002 and 2001, 2008, and 2022. Okay, and then this article, again, a few statements from Jim Cramer. I agree with a lot of things he says. I definitely disagree with a lot of things he says, but this I do absolutely agree with. And he's just talking about why this is different than why the current market environment in 2022 is different than that of in 2001 and 2008. So we'll read over this, of course, expand on this. We have said pretty much this exact thing before, but nice and composed here. So we'll read through it and expand our thoughts, our personal thoughts after reading it. Okay, speaking of personal thoughts, after we go over a couple of these CNBC articles, I want to touch on one of my recent newsletters where I talk about the psychology of fear going on, why I actually think headlines like this and just the general bearish sentiment floating around is good news for the markets. Again, playing the game theory aspect of trading and whatnot. So we'll go over that. That is what I touch on in this newsletter. And I do also touch on the Jackson Hole, Wyoming Fed meeting that is occurring this Friday, which I believe will be, personally think will be a catalyst for upside. And I'll explain why that is in this newsletter as well. Okay? Hope you guys are ready. To close it out, I do want to feature a chart from actually the newsletter that I just wrote earlier today, this morning. So you guys are getting some nice break-in, nice fresh content in this one. But this chart right here displays institutional put-call ratios. So this is showing what the whales are doing, what the big money's doing. Ultimately, you want to know what the big money's doing because it's probably a pretty good indicator of what's going on. But in this case, it's looking like things are getting a bit overextended. And as we say a lot around here, reversion to the mean is necessary. And this is yet another indicator that looks like there is some upside mean reversion to accomplish. Okay, so that's the video today. Again, you guys, I was excited to make this one. This is a lot of stuff that I do enjoy talking about, and I hope you enjoy it as well. If you do, please give the video a like. And let me know in the comments down below what you think is going to happen over the coming month or two. I'll just say right off the bat, I am bullish. And always know, you guys, my money is where my mouth is. So if you do want to know how I'm trading on a daily basis, there's this. We'll shout this out at the end. But what do you think is going to happen over the coming month or two? Personally, I think up until mid-September, we see predominantly green. I think things can start to get shaky depending on how the September Fed meeting goes come mid-September. But when it comes to the next 30 days, I am feeling mostly bullish. And once again, Money Where My Mouth Is, complete portfolio daily newsletter, which are these guys. Again, I'll shout this out more at the end, but know that if you want to track and just stay up to date with how I trade my personal portfolio on a day-to-day basis, the entirety, call options, put options, stock positions, crypto positions, which I do update every trading day, along with the newsletters, which rationalize my thoughts. That's the first link down below. Again, further plugs in the end, but appreciate you guys watching. Berenstain Bears is one of the funds Bernstein thinks this is just a bear market bounce. So let's read why that is. The market bottom isn't in yet, according to Bernstein. The U.S. stock market has been in a bear market for 8 months, which is the same length as the average bear market, excluding the tech bubble and the global financial crisis. So right off the bat, again, if you remember what I said earlier in the video about disproving this being similar to the tech bubble and the 2008 financial crisis, this is very good because as of right now, this is pretty much the average time for the U.S. bear market. Okay? Said Bernstein Asia quant strategist RuPaul RA. I'll just call him RA. In Asia, the bear market has gone on for 14 months, which is the average length in that region. So as of right now, we are at the historical average length of a bear market in both the U.S. and Asia. That in itself is a pretty good sign. So it's interesting that an article skewing bearish did kick it off with that. But however, she told clients in a note Monday to expect more pain ahead. We would be surprised if this was the end of the bear market, as macro risk has never been this elevated. None of the bear markets since the Asia financial crisis, which spanned from 1997 to 98, have coincided with a high inflationary regime globally. And all major global synchronized crises ended with a moderate inflation/low growth regime, she said. Global inflation still remains at record levels, while leading growth indicator has not yet entered a recession, referring to standard deviations. There have only been 2 instances in the U.S. since '96 when a bear market lasted longer than 6 months. The early 2000s tech bubble, which went on for 25 months, and the global financial crisis, which began in late 2007 and lasted 16 months. Okay, so 25 months, 16 months. Currently, we are at, where are we at? 8 months. I don't know why that's the only one that's written out, but 8 months. We're currently in a correction in bear market, in an official bear market of 8 months. And again, that is the U.S. historical average, which in itself is a good sign. And let's read why 2022. And again, if you remember this, we've made this argument many times in the past. Why this isn't the same as 2001 and 2008. Okay, these are completely different macro environments. So again, let's read through this. I'll expand on anything I feel necessary. In 2008, the S&P 500 was down about 12% at this point, and in 2001, the broad U.S. stock index was lower by nearly 12%, Kramer said. In both years, the S&P 500 had bounced off earlier lows to get where it was in late August. However, Kramer said it's incredibly important to go beneath the chart level surface before concluding the stock market will end 2022 on a sour note. Not only is the U.S. economy at a much different part of the business cycle than in 2001 and 2008, but Kramer said major destabilizing events were primary drivers of the year-end slides. I just don't see a parallel in this year. 2008, it was the reverberations from the Lehman Brothers collapse nearly bringing down the financial system. In 2001, of course, it was 9/11, and in both these scenarios, okay? Again, you guys, in 2008, if you guys have watched The Big Short, you would know this. In 2008, it was pretty much a flaw in multiple aspects of the financial system. The banks were over-leveraged. Everyone was over-leveraged. Everyone was giving out. Every bank was incentivized to give out trash loans. And because it was pretty much built, because so much assets were built upon a house of cards, those assets completely just were eliminated once that base layer was wiped out. Okay? If that makes any sense. But go watch The Big Short, great movie regardless. In 2001, of course, the tech bubble, very similar to the ICO bubble, the initial coin offering bubble, just the crypto bubbles we see, where projects could just put .io at the end of their website, could say they are in the DeFi sector, could just make any claim they wanted. If you're a crypto, there is the pump power, and that's what happened in 2001. Okay, it was the .com bubble because any company who put .com at the end of their company name or of their stock name went ballistic, but there was no underlying revenue or no underlying business in many cases to actually back that up. Okay, right now it is different, and this is a very, very uncertain, 100% uncertain. There are still a lot of crazy things that Europe is going through an energy crisis right now. The euro is in weird shape. That's a great argument. I mean, Russia, Ukraine, that could obviously go south, and China is in a weird place as well, just from an economic perspective. So there are still a lot of potential things. I don't want to say small things, but like micro factors that could turn into macro factors, and like a lot of potential issues that could turn into major issues and black swans. But as of right now, earnings season was strong. That's a good sign, right? Earnings season, pretty much I think at this point, 70 to 75% of all companies who announced earnings over the course of Q2. So because it's over, I guess, say 75% of all companies who reported over the second quarter and gave their Q2 reports beat analyst expectations, okay? So that in itself is a good sign. Things aren't as bad as a lot of analysts and a lot of investors believed it to be. So from an economic perspective, things aren't really slowing down yet. Spending has slowed down, and spending is becoming more focused in certain realms of the market that aren't as recreational, of course. But things really aren't as bad as a lot of people seen. And inflation, of course, is evidently cooling down. And I don't think it's possible that June was not the peak inflation month. I don't think it's possible. And I think inflation will be significantly cooler once the August numbers come out in a couple of weeks. Okay, so that's just my thoughts. Let's close it out here. Kramer said there's always the possibility, again, I just kind of alluded to this, of a so-called black swan event, noting there is inherent uncertainty about what lies ahead. If something terrible happens on the scale of Lehman Brothers collapse, then I would indeed change my mind. However, he added, there is a bottom line. Unless something terrible comes out of nowhere, I'm feeling pretty sanguine about this market because 2002 is not 2008 and it's not 2001. Okay? And I feel the same way for all the reasons I just mentioned. Again, inflation is cooling, earnings and just corporate numbers are a lot better than a lot of people expected them to be. That is a fact because once again, 75% of companies beat analyst expectations. And I mean, it just makes sense that although a correction was absolutely due in the markets, that's why we've seen so much corrective price action over recent sessions. The fundamentals really just don't coincide with this. Of course, interest rates are raising. That's what we're going to cover a little more here. Interest rates are raising. Historically, an environment where interest rates are raising is bad for the markets overall, specifically tech and growth sectors, which we are, of course, very involved in. But, I mean, again, you guys, mean reversion is necessary. I still believe even at these levels, many growth stocks and small caps specifically, as you guys know, are still oversold and do still have further mean reversion to accomplish, okay? Speaking of that, actually on top of this, I wasn't going to show you guys this, but I do, speaking of growth stocks being oversold relative to large caps, I'll show you guys this too and just talk about what that is at the very end of the video, which was, of course, also in this morning's newsletter. All right, where were we? Right here. Another day downside, another day to capitalize. Again, you guys, money where my mouth is. The markets are seeing yet another day of red as we kick off the final full trading week of August. Significant technical resistance can take the majority of the blame for this pullback, but the primary fundamental headwind at the moment is the Federal Reserve meeting in Jackson Hole, Wyoming this Friday. Covered my thoughts on in the last video I posted if you guys want to check that out. But to sum them up, I don't think Jerome Powell will whip out his talons and get excessively hawkish, as the street likes to say. That pretty much just means you're offensive, you're on offense. He's going to come out guns a-blazing and raise rates more than anyone else believes. I don't think that's going to be the case because this is virtually a Fed vacation where they go for hikes and whatnot, and I'd imagine he won't be feeling very doomy and gloomy. Okay? I mean, look how beautiful that scenery is. And this is just a picture of him and his boy, I guess, in Jacksonville. I'm not sure who that is. But beautiful. I've heard from multiple people in the know, analysts and reporters, that this is a pretty casual event for the Fed. I imagine they're just going to stick, I think the worst, this is just my opinion, of course. It could not happen this way, but what just makes intuitive, reasonable sense to me, given the nature of they're on holiday, they come back next month, they're taking a breather, they're going for hikes, they're just chilling out. It doesn't make sense, especially with inflation cooling, that Jerome Powell is going to come out and be like, we're going to hike rates more than we previously expected. I think worst case scenario is that he just reiterates everything he has been saying, which is that, yeah, obviously rates are going to continue to raise. So I don't know why the markets are reacting viscerally to this. And I actually don't think it'll last long. I do think this will be a positive catalyst for the markets. Okay, ultimately once Friday comes, but hey, if you're watching this after Friday and I'm right or wrong, let me know in the comments down below as well. That said, I think that investors do think this will be the case. Fear is creeping back in. Over-leveraged longs are getting liquidated, which happened over the past couple of days. Today was a little chill. And the talk of this being just another bear market rally is beginning to sound like a pretty decent argument. I think that once all of the doomsdayers start saying, I told you so, will act as a pretty good indicator of when the markets will flip back into bull mode. If not by week's end, I do believe the Jackson Hole meeting will bring relief to the markets. I stand by the statements I made on Friday. I do not think this is a bear market rally. There were enough objectively positive fundamentals over the past month to justify the recent upside. Once again, positive earnings, consumer spending picking up a little bit, and inflation cooling. And I believe that upside will persist over the coming month. Yeah, bullish on the 30 days. From there, because we'll cross that bridge when we come to it. So subscribe if you want to stay tuned. When there's blood in the water, you want to be a shark, not the prey. I took advantage of this downside once again, and I'm glad I had some profits from my hedges to fuel the frenzy. Okay, so I guess right now is a good time to plug before we dive into these final charts. You guys, if you want to know how I trade my portfolio on a day-to-day basis, already shouted out, hey, join the Discord group if you want to. Good stuff in there. But my complete portfolio daily newsletter includes a complete breakdown of my entire personal portfolio. Once again, all of my options, call options, put options, stock positions, cryptocurrencies, which I do update every trading day during market hours with the trades I've made, and Alert Waves Capital. You'll also receive my 3 daily newsletters, which include my trade alert, macro analyses, and price targets. I've only been doing the macro analysis a couple times a week now because it's a bit slow, but you guys, I spend the far majority of my days, of my mornings, as I trade. I write the newsletter. It's very up to date. So if you really want to know what I'm doing, once again, just in real time, then check this out, Join Waves Capital. If you do, welcome to the winning team. That is going to be the first link in the description box down below. Choose any of these payment plans you want. Doesn't make a difference to me, but yeah, give it a shot. You can always unsubscribe, but I trust you won't be. So once again, welcome to the team in advance. Let's close it out by taking a look at this chart. Once again, on the notes, I'll just show you guys this real quick. So, primary reason I wanted to share this chart was because it displays that small caps remain undervalued relative to large caps. 15x is on the lower end of the average PE multiple, which is what this is. So this is 12 months forward-looking revenue in terms of valuation of the company and market cap. And I think we need to see that multiple achieved to believe we've accomplished true mean reversion on this front. So S&P 500, this is why I remain more bearish on large caps than small caps. These are so ridiculously correlated that it kind of sucks, but I think at some point this correlation will break to some extent, and I do think small caps will continue to outperform large caps over the remainder of this year, and once again, that is completely reflected in my portfolio. All right, as you can see here, small cap 600, we are at a PE ratio of under 13 of just like 12. So that's crazy for a lot of these hyper growth companies, and again, they do get punished in an environment of raising rates, but when you got some great companies, like SoFi is an amazing example of this right now. Still one of my favorite trades. I'm still super bullish on SoFi. Unity Software as well is one that I'm really excited about right now. So anyway, small caps trading at like pretty historically low multiples, at least over the past near decade. Of course, the pandemic we saw that crazy black swan low, but the fact that we're back down to around where we were as far as multiple valuation is concerned. Again, pandemic level lows, that just doesn't make any sense. And I do think small caps, specifically small caps and hyper growth stocks, which is again what I personally trade, do have a lot more room for upside mean reversion, which just means you're too high, you need to go down. You're too low, you need to go up. You need to find that comfortable medium. Okay, so upside mean reversion, just mean reversion in general, something we talk about a lot in the videos, as many of you know, and in the newsletter as well. Okay, so let's talk about this and just close it out. The chart below displays institutional put-call ratios, and large funds are currently holding near-record short positions on the S&P 500. This isn't a guaranteed indicator, and these shorts could prove lucrative for these funds. But I don't believe that it will be the case. Fearful when others are greedy, and greedy when others are fearful. Who said that? Let me know in the comments down below. You'll win you'll win a heart. We haven't seen the levels we're currently at since 2015, and just looking at the nature of the uninterrupted descent we've experienced over the past 6 months, I'd imagine we're due for a bounce, maybe even somewhat of a squeeze. So the good old short squeeze. I don't think it's not going to be like a crazy short squeeze, you guys. Not like the meme stock squeezes, of course. But when there are a lot of shorts on some of these significant and massive and liquid as the S&P 500, those shorts slowly but surely will have to cover their asses, cover their shorts. To do so, they buy stock, ultimately driving the price up. That is what a short squeeze is. So this could be a short squeeze, just on not the stupid levels that many people think of short squeezes as now. Okay, so again, we are currently nearing levels that we have not seen since 2015, and levels that we've really rarely scratched before. If so, you can see that we have almost always seen a bounce, a very significant bounce at these levels. And again, the harder you fall, the harder you bounce. We have come straight down. This is a fall off a cliff. This is the opposite of parabolic. So if we go head first off a cliff, it only makes sense that the bounce is pretty parabolic as well. And I do think some of these puts, some of these short plays will be liquidated. We'll have to cover their asses and create a lot more upside momentum and a lot more momentum in favor of the bulls and in favor of those holding call options. Okay, so that's a video, you guys. That one was a super fun one to make. Just a good time reading. I always enjoy talking about the macro because, again, it's so important as a trader, and it really keeps you just sharp to understand the macro. Again, when you understand the macro, you excel when you perform the micro. Even if it doesn't have anything directly to do with what you're trading, it always has something to do with what you're trading. There's always something in the macro that, like right now, rates raising is pretty much dictating the direction of the overall markets. The S&P 500, we were following, this is macro, the S&P 500 perfectly tested resistance. That's why I was covering it so much in the newsletter. Once it tested resistance, that marked the exact top, like to the T, to the candle wick. Tested resistance, boom, the whole market flipped. Okay? And that's why our hedges over the past few days have providing us with capital to deploy into some of my positions that have been down and that I believe in over the next 30 days. So, again, you guys, join Waves Capital, step up your trading game, step up your investing game, and once again, welcome to the team in Advanced. I'll talk to you guys downstairs in the comments. And until next time, always remember, take action, make waves. Peace.